Hey everybody, we're going to get started in a minute. I'm Nick Dukoff, Head of Institutional Growth at the Solana Foundation, and I'm joined by my colleague.
Hey everyone, my name is John. I run the engineering team at the Solana Foundation.
So raise your hand if you've been rugged today. You all have been rugged. We're not doing a live demo. We're actually going to do slides. But if we get through them all, we can allow for some Q&A if you have any questions, okay? So to the extent that you're not familiar with Solana, Solana is a high-performance layer 1 blockchain. It's very, very fast and very, very cheap. And as the CEO of Miston Labs was just talking about, it's ultimately the developers that are going to find the ways to get the best leverage on that core technology. So they have done so, right? We've got 40 million daily transactions on the Solana blockchain and about $4 billion in daily on-chain volume. I imagine today that will be higher than average. We also have 4,500 nodes running the network all over the world. And as I mentioned, low fees, about 1,000th of a penny, and very fast confirmation times around 400 milliseconds. We also have very high throughput, 65,000 TPS today. Jump Crypto is building a new independent validator client for Solana called FireDancer, which is on testnet now and hopefully on mainnet soon. And that is seeing performance upwards of 1 million TPS. Oh, there we go. All right. So a couple did you knows. Did you know that Solana is the #1 blockchain for stablecoin volume? So this was as of October 31st, but you can look year to date. Solana is the bright green bar. You can see the performance over the course of the year. Beginning of the year was really ripping. Summer was a little slower. We're picking back up in the fall. If you add up all the other blockchains, that's about the stablecoin volume on Solana, $8.7 trillion year to date. Solana is also the #1 blockchain for DEX volume. Recently flipped Ethereum mainnet for DEX volume, and the trend is pretty clear that it's going to continue to pull away. As I mentioned, these trends are accelerating. Net inflows to Solana in the past 3 months was over $1 billion net, about 1.5 billion in and 400 million out. And this is not just degens trading meme coins. The world's leading financial institutions are building on Solana too. Just this year, many of these great global firms have announced plans or are already issuing tokens on Solana. Hamilton Lane issued a private credit fund on Solana. Brevin Howard issued their flagship hedge fund on Solana. Franklin Templeton and Wellington have announced money funds on Solana. Securitize, who is known for being the transfer agent and tokenization platform for BlackRock's BUIDL money fund, announced plans to issue natively on Solana. Societe Generale, who I saw one of our good friends from there here today, Charles, is issuing a Euro stablecoin on Solana. And Citi announced that they're connecting their Citi digital asset platform to Solana as well. And this is in addition to Visa, Stripe, and PayPal, some of the world's leading financial services firms who are also all building on Solana. So in short, you'd be in very good company if you chose to build on Solana. And speaking of building on Solana, I'm going to head it to our head of engineering at the foundation, John.
Hey everyone. Excuse me. Sorry again for rugging on the live demo. I do have a judicious use of code. So if you have questions about that, I'm happy to go through that in detail. I will hopefully make up for it with giving you more information about stablecoins, tokens on Solana, and what you can ultimately use Solana as a blockchain for. So we've seen a lot of people building on top of Solana, and I want to give you a sense of why they're doing that. One of the things here is that Solana is designed for fast and cheap payments. There's a graph. It's a little hard to see on the bottom right here, but the thing that you see spiking up, that's the average fee. You can think of that as like, hey, here's the price to get a transaction on the network for a specific thing. The one that's on the flat and it's next to the bottom axis there is the median transaction fee. That's the clearing cost of a transaction on Solana, which today is about less than 1/10 of a cent. What that means is that these sort of payments use cases, peer-to-peer transfers, that sort of stuff, they're clearing at a much lower price than the things that are contentious. And part of that is due to how Solana itself is designed. By having the ability to execute transactions in parallel, you can have different fee markets for different things that are happening. So if there's a big, I don't know, prediction market that's sort of resolving things over here, and you're just trying to send money to, settle up a sandwich for lunch, those are in different lanes, right? You're going to pay different fees for those different things that are happening. You combine that with fast finality. In about 1 second, you get that optimistic confirmation on Solana, and you combine that with not having the concept of reorgs past that point, and it means that you pay for a coffee at the point of sale, and you can walk away knowing that transaction is not just going to magically disappear. The last thing I'll mention down the payment side is specifications like Solana Pay give a really strong, standard for people who are accepting payments in different places. It seems like that may not, is not exactly what everyone's using Solana for, but I think it's good to know that the chain itself is capable of doing all of these things. I'm going to talk a little bit about this chart from the Visa on-chain analytics dashboard, because I love how it represents what things are actually happening on-chain. It's hard to see on the left side. There's a y-axis on the transaction count. This year, there's been 1.6 billion transactions sent on the Solana network, which is almost twice as much as the next chain on this thing. These are transactions focused solely on stablecoins. This is not all transactions. It's just stablecoin transactions. But I'll also draw your attention to the composition of those transactions. On the right side, you'll see the legend. The legend shows that blue hashed, like crisscrossy thing, I don't even know what you call that, is transactions of less than $100. So when you have a fast, cheap, efficient chain like Solana, you get really interesting payment scenarios where, for example, if you wanted to do hourly dividends to hundreds of thousands of people, that is totally a plausible thing because every transaction costs effectively less than a cent. Right? So we're seeing these stablecoin transactions on Solana. More than half of the transactions on Solana that involve stablecoins are less than $100. These are not just big, huge whale transactions, although they are there present as well. So to understand why this is happening on Solana, actually think this might be the wrong slides. We'll just double check. No, good. So one thing that's really interesting about the nature of the token economy on Solana is just how many tokens there are. So I talked about stable coins. You've all probably seen things like meme coins and Peanut the Squirrel, RIP. Like there are something like 20,000 new tokens showing up on chain on Solana every single day. And if you chart that across all of the other chains that are listed here, there's 30 chains that are listed on here. Solana is responsible for 88% of all new tokens across every chain. Why is that happening, right? How is that even possible when we think about tokens and smart contracts being complex constructs that may not be that accessible? But what's interesting about it is on Solana, the token contract, this is a chart of all the programs, all the smart contracts on Solana based on how often they're invoked. And right at the top is the SPL token program. What's cool about this token program is that it requires no smart contract development to use. You're not customizing and deploying your own smart contracts for every token. You're using an existing battle-hardened token contract that gives you everything that you might want with a token. Mint, burn, transfer, freeze, delegate, all the good stuff that you need. This same token program that's being called 100 so million times a day, this is on a daily basis, is the same token program that powers USDC, is the same one that powers Peanut the Squirrel, right? So both of these things use the same smart contract under the hood, and it means it reduces the sort of risk area for implementation issues and other things that you might see when you have to copy-paste things and in different places. So from a developer standpoint, that means that zero to token is about making a transaction and sending it to Solana, not about having to figure out smart contracts and deploying them on chain. Okay, so where does that, what's the relevance to token extensions? So token extensions is an evolution of that same token program that we see so often on Solana. It's actually a strict superset of the same capabilities. So all of the things that you know and love about the SPL token program are also present in token extensions and much, much, much more. So the same concept of low-code programmability. In many cases, you may not need to customize any smart contracts at all, but what it does do is that it gives you a bunch of levers, configurations, things that you may need for your product or for your business. This token standard, it was actually very purposely built for digital assets. I'll talk a little bit about how it's being used in the institutional space. And I think what's cool about this, again, you have very little smart contract development. You can create your token and you specify exactly what things you want it to do, very similar to how the SPL token works. So there's a bunch of extensions. I'm actually not going to go through them all in detail. I'm going to talk about 3 concrete use cases that may be relevant for you, and then we can go into more specifics on the actual extensions themselves. So who's actually using token extensions? So the best example is actually PayPal. So the PayPal USD product issued by Paxos, regulated by the New York DFS, is built on the token extensions smart contract, the program. And they have this great white paper that outlines all of the reasons, yada, 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 fast, cheap, all that good stuff about Solana, but specifically about token extensions, they echo a lot of the things that I just talked about in terms of reduced risk, right? Because now instead of a custom implementation that is prone to bugs, you have a battle-hardened, audited smart contract that you can reuse. It also means that for them, that's way less reduced development. They didn't have to develop a custom smart contract for PayPal USD on Solana. They're able to just use stuff off the shelf. Those token extensions also give them a lot of the capabilities that they needed to be regulated by the New York DFS, right? The controls that might be needed for any stablecoin issuer in different, sort of regulatory jurisdictions. So you can mix and match these different extensions based on whatever things you need. And they're right there out of the box, right? Again, very little custom work needed or any understanding of Rust, really. Okay, so I suggest you take a look at the PayPal USD white paper. They outline a lot of this stuff in detail, and they did a lot of due diligence on this. Like, if you are a developer and you know anything about tokens on Solana, you'll know that Token Extensions has a technical name, which is Token 2022. It is the year of our Lord 2024. It took a while to get this thing to market. The point, though, is that this thing has been in development with the kinds of stakeholders like PayPal in the world to understand what their needs are and to be able to support it in the actual token smart contract itself. Okay, so here's a few use cases that you can actually implement with token extensions that I think are a good reflection of how you might be constructing your own tokens. So one of the things that people ask for a lot is this concept of a whitelist. It's like, hey, there's a list of people that are allowed to have my token. There's a list of protocols that I have partnerships. They're allowed to use my token. Everybody else, I don't want them, right? For whatever reason. And if you are a developer or you kind of have a technical mind, you may think about what does that process look like. And it looks roughly like a literal list of all the addresses that may ever be relevant for this particular token. And you know that if you are trying to grow your user base to millions, that list is intractably long. And whenever you need to add or remove addresses on that list, it just takes a long time computationally. Find the address in this list, remove it from that list, read from this list that's millions of millions of addresses long. It's actually computationally inefficient to do those things. But on Solana, with token extensions, there's this new capability called default account state. And when you set that default account state to frozen, you get this really cool capability. And that frozen state can be undone. You can thaw someone's account with something called a program-derived address. It's a smart contract, right? So if you combine those two things, it means that any net new holder of your token, they cannot send or receive any of the token until they pass some gate, right? That gate could be KYC. It could be sign up for my website, sign up for my application. It could be like verify that you're not on the sanctions list. But once you get that process done, that can be evaluated from a smart contract standpoint, the smart contract can go ahead and thaw your account, and suddenly your token is free floating amongst a whole network of other people who have also been validated through that same process. right? So you don't have to think about an arduous, like, long list of addresses that are on this list. Everyone's individual accounts holds that state. And just by the virtue of it being unfrozen, being thawed, means that it's part of that network. So you can imagine this, extending tractably to millions of different account holders. Okay? So frozen by default, it's really cool. It seems like a small thing, but it's actually quite a clever way to solve this particular problem. Here's my judicious use of code. If you look at this, what we're doing here is constructing a Solana transaction. There's two instructions on here. One is initializing the mint. This is just creating your token, as it were. You set your decimals, that sort of stuff. You set your mint authority and your freeze authority. Freeze authority can be a multi-sig, it can be a smart contract wallet, it can be a key pair, it can be a ledger, whatever you want it to be. It can be a DAO, right? This is the cool part about composability on Solana, is that anything that's an address could be a DAO, a multi-sig, a cold wallet, whatever you want it to be. And the second instruction here is setting it to frozen. That basically just says, look, anytime anyone attempts to create a new account, the same way that you open an account at, I don't know, Bank of America, you open up a new account, it's going to be stuck until you sign up, right? Or do the thing that opens up the gate. And that's it. You send this transaction to the network. It takes about 1 second to confirm, and you're golden. You've created a whitelisted token that people must ask for your permission to be able to hold, send, and receive. Great. Easy enough. Second use case, confidential transfers. So this is actually not a use case. It's more like a capability of token extensions. And I actually think it's one of the more compelling ones. A lot of people are surprised to hear that this is even possible on a public blockchain. When we think about issuing assets on chain, people are always worried about, okay, I'm a merchant, I'm either a public company, or look, I just do a lot of revenue, and I don't want to share that to my competitors. And so that's why they don't use a public blockchain. I don't think that's true anymore. With things like confidential transfers, you can actually mask the sensitive part of it. In this case, the actual balance of the amount being transferred. The source and the destination and the token type are all public. So PYUSD has this capability available, but the amount is encrypted. And that encryption, you can set a few different things on it. One, you can set an auditor, which is great. They can go in and audit, make sure that all the books true up. You can also have complex opt-in flows. You can have permissioned confidentiality. So maybe the public balance of a particular token is free-floating, everyone can use it, it's in DeFi, it's all good and well and good. But if you want confidentiality, you have to KYC or KYB or have some other permissioning to know that, hey, they're allowed to do this. The other thing is that account holders have to opt in. You're not going to arbitrarily receive confidential, transfers of anything. You yourself have to opt in because you're issuing your decryption key. And even after you opt in, you can add in another permission to say, hey, even though you have opted in, I have not let you opt in. Therefore, I can give you another gate here, right? So we expect that people will use this. It's using something called bulletproofs. Zero knowledge on blockchains, on the public permissionless blockchain, and it allows you to take advantage of the broad swath of different DeFi protocols and all that sort of stuff. But for the sensitive things, you can mask that particular balance. Cool. So confidential transfers, it's an extension in the token extension suite of tools, and you can actually set that on your token. Again, it's as easy as the example I set before, except you use a different extension. This one is the confidential transfers extension, and you can set a few things. I've highlighted here just for people to seize when you want to make sure that there is one level of permissioning to make sure that only people who have permission can use confidential transfers. You just set that thing from true to false. Great. Send this transaction to the network, takes a second, great. You have a token that has both a public and confidential balance. Great. Let's go to the third use case. So the third case is securities. So there's a whole host of things like real-world assets that have constrained user bases, right? You cannot have this thing free-floating around, maybe because of sanctions, maybe because they need KYC, they have to be an accredited investor, maybe they just need to attest to who they are before they have access to this thing. And great, we have an extension for that too. So there's a thing called transfer hooks that actually lets you have a third-party program that validates every transfer of this particular token. And in that transfer, in that smart contract, you can actually validate a number of things. As I mentioned, attestations like KYC. You can also attest. You can also check, hey, there's a daily spend limit. You can't spend more than 30,000 of this token every day, like come back tomorrow kind of deal. It's also an opportunity to hook into complex policy engines, right? So I mentioned this before, but anything that's a public key can be pointed to a DAO or a multi-sig or something like that. And in this case, you can actually have something like a smart contract handle very, very complex policies related to who is able to actually interact with this token. One great example of this on Solana is something called Medici. It's a RWA standard that lets you establish a bunch of things like, hey, here are the kinds of investors, here's how many investors can actually access this thing, what regulatory jurisdictions are they in, here's their constraints, that might be different from this person's constraints, that might be different from this one. But the token that represents, maybe it's a fund or a security, doesn't care about that. It's going to go ahead and get blocked if it's not a valid transfer or something like that, right? And you can reuse these things on chain as well. So if I wanted to issue 10 different securities and reuse the same policy engine, you can go ahead and set it to the same address or the same smart contract under the hood, right? So that complexity, I actually didn't show the code for this one, but generally speaking, securities using transfer hooks, pretty easy to manage given the smart contracts that already exist on chain. I've talked about 3 concrete use cases, but there's a whole host of other things that you can also build with token extensions. Some examples of that, rebasing tokens with interest-bearing extension. So have a few folks in the crowd that have had this consumer issue where rewards bearing tokens don't make sense to consumers. They say like, look, hey, I've created this US dollar denominated stablecoin. It has 5% yield, and my token does not go up. It's like the price goes up, but my token supply does not, even though in reality I do have $1.08, $10.20 of something, right? You want the supply to go up because that's how we internalize interest in our savings accounts and bank accounts and stuff like that. Not that the token itself is now worth more money. Right? So with the interest-bearing extension, you can actually set the interest rate on a token, and you can have that be dynamically adjusted. So if you want it to update every 3 minutes, you can have you can point that same thing to a smart contract. The smart contract reads from an oracle and says, look, here's the run rate of, the FX rate of some yield-bearing thing off-chain. You can set it every 3 seconds to adjust the interest rate over time. And in someone's wallet, they will see their supply go up, but the price is stable at $1 or a pound or a peso, whatever you want it to represent. It will be stable at that price because it normalizes based on the rebased price, not the actual supply, or sorry, not a rewards bearing version of that token. There's other extensions like permanent delegates that allow you to express other really cool things, like if you have a license. Like, hey, you have a software license that accesses this thing for 30 days. It's NFT, and it's a rental, right? Licenses are rentals. And after the 30 days, you can go ahead and reclaim it from their wallet using the permanent delegate. If you're economics nerds, harbinger taxes could be implemented in this way with property taxes in different markets around that. And if you need to, for whatever reason, seize assets because a court has compelled you to do so, you can freeze and then seize the asset using the permanent delegate extension that you add to the token itself. We've also seen folks use things like the transfer fee extension, which lets you set a basis points that gets withheld on every transfer of a particular token. And you can also set a max limit. That's actually pretty novel economics for folks that are doing things like tokenized gold, where maybe it's not the custody that gets the money, it's actually people using it in different ways that gets the money, so the transfer fees make a lot of sense there. And there's a couple more that are cool. For those of you who are sort of more in like the merchant e-commerce space, you may want to require that someone send an invoice number on chain. You can require that a memo is attached to every single transaction. And then you combine that all with the fact that on Solana, smart contracts can do everything from owning tokens. They are smart contract wallets that you can specify. You can create smart contract wallets, which allows you to express things like escrow. You can have joint ownership with a group of folks. You can fractionalize assets and hold things in escrow. And lending, all that stuff is powered by the fact that Solana has this native accounts model that powers all of the smart contracts on Solana. So all of these cool advanced constructs sort of like dreamt up recently in other blockchains is just fundamentally how Solana is built today. And every protocol takes advantage of these capabilities. Cool. So overall, if there's anything that I can leave you with, token extensions allow you to build permission tokens on the broader public permissionless network that is Solana. There's a great site. There's a bunch of stuff there on Solana.com. I'm John. This is Nick.
Thank you. And I just wanted to do a special call out to, there's a lot of Solana builders here in the audience today, and John and I stand on the shoulder of giants. It's all of the innovators building on token extensions in the Solana blockchain, so thank you. And if you aren't yet building on the Solana blockchain, please come find John and I, and we'll try to make it as easy as possible for you.
Thanks, everyone.